Namaskar. In this session of Swayam Prabha, we are going to talk about salary components, tax and investments. In this session, we are going to understand what is salary and what are its components, how exactly should the income from salary be used for investment, for creating wealth and for paying taxes, etc. Salary should be differentiated from wages. Salary is a fixed periodic payment to an employee, typically paid monthly, but sometimes weekly or bi-weekly. Wages on the other hand are paid on basis of number of hours or on a per unit of production basis. Salary varies depending on the job position of a person, location, experience and often includes allowances and other benefits like health insurance and paid vacations. In private sector, salary is often negotiable at the time of hiring. It is a compensation for the role and services provided and not necessarily for the specific number of hours worked, especially if a person is working at a higher level. Salary in the government is based on pay levels or scales of pay which are decided or declared by the government based on recommendations of various pay commissions. The listeners might be aware that recently Government of India has notified 8th Central Pay Commission and it has the authority to modify the salary structure, the allowances, etc. So, in government, basic salary is the major component of the salary, and in addition it has dearness allowance, house rent allowance, city compensatory allowance, transport allowance, conveyance allowance, etc. There are some special allowances like non-practicing allowance for doctors, risk allowance for health care workers, other health care workers, uniform allowance, washing allowance, child education allowance, newspaper allowance, telephone reimbursement, etc. And in salary there are deductions which are done for provident fund or income tax, monthly income tax deductions which are called as TDS. In the private sector, often the term CTC or cost to the company is used, which is the cost of acquiring and retaining an employee and is considered as below. It has basic salary, allowances like house rent allowance, transport allowance, sometimes vehicles are given. Then there are other benefits like employee provident fund, in which a certain percentage is given is contributed by the employee and the same percentage is contributed by the employer. Then there are insurance, and here also the monthly deductions are done from salary for provident fund and income tax, etc. Everyone who is drawing a salary should be aware about the government's notification about income tax. The new income tax regime, the slabs for financial year 2025-26 which is running, which is also the assessment year 2026-27. So, the slabs are simplified that any income which is more than 12 lakhs and less than 16 lakhs has a rate of 15%, 16 to 20 lakhs is 20%, 20 to 24 lakhs 25% and above 24 lakhs the slab rate is 30%. This has to be compared from an old tax regime which is still continuing for those who are wanting to get benefits under section 80C, that is whatever they have invested in PF or ELSS, LIC, PPF, NSC, etc., or people who have drawn house rent allowance or are drawing benefits of paying housing loans. The new tax regime for income tax should be compared with the old tax regime which allows deduction under section 80C, under section 80D and home loan interest and donation, etc., under 80G. The income tax portal of Government of India, it has a facility that a person can calculate and find out whether he is getting benefit under the new regime or the old regime, and accordingly he can select. People who have been investing in the past in various instruments under section 80C or 80D, or people who have taken home loans, they are the ones who might still be using the old regime, but more and more people are now converting from old to the new income tax regime. Then filing of income tax returns is a duty of all income tax payees. They must take a note that ITR has to be filed before the due date if you want to avoid fines or late fees. These can be paid, income tax return can be filed online on the portal of Income Tax Department, which is www.incometax.gov.in. Filing ITR on this portal is easy and secure, but remember, one must choose the correct ITR form depending upon what are their sources of income. For people who have income from salary, it is easy, but if a person has income from dividends, income from share market, then the capital gains, or income from business, income from profession, then they have to use the prescribed ITR form. They must verify themselves on the portal by using their Aadhaar based OTP and their salary certificate of TDS in form 16, that should be ready with them while they are submitting the ITR. Then there is a form 26 AS, which is prepared by the Income Tax Department itself and is available to all assessees. It keeps a record of their income and the tax deducted at source, and this is referred to while filing the ITR. If there are no differences, if the 26 AS has recorded all the details correctly and if the assessee is satisfied, then it makes the whole thing very easy. Then bank statement should also be kept ready in case there is a big transaction, there is a large transaction, then explanatory statement might be required in the income tax return. Just a word about calculation of tax liability. It is not difficult, and the portal of Income Tax Department, it actually helps a person in calculating the tax. One has to just know the income from salary, from other sources, from capital gain, business or professional income as I told, and then calculate the total income. Work out the deductions that can be claimed under various sections of income tax, calculate the net taxable income and calculate tax. Normally, this is done in private sector by the HR departments and in the government sector by the accounts department, where the employee gets full support and help in filing ITRs. Now, what is the 70-20-10 rule for managing income? It is technically a budgetary strategy which divides the take home salary or take home pay into 3 categories. It is a simple framework to balance the essential living costs, long term financial goals and financial responsibilities. In essence, 70% is allocated for one's day to day needs. These are for essential expenses like housing, utilities, groceries, transportation, insurance, etc. 20% is kept for savings and investments. This is designated for investing for long term wealth or for retirement benefits, and 10% is for wants and debts. This is a flexible category for paying debts or for wants which are like hobbies, travel, donations. Please remember, this rule is just a guideline. It is just to impress upon the fact that one must budgetize the income. If you do not do that, then one will not know in which area a person is not investing properly or what are the future needs of the family, are they being catered to. So, budgeting has always helped, and 70-20-10 rule is basically to help. Then there are certain investment options which are available for the salaried class. The commonest are those which have fixed income return, which are like fixed deposit, recurring deposits, public private funds, investment in bonds. Then there are market based products like shares, stocks, mutual funds, exchange traded funds. Then one can also invest in gold, silver or real estate. There are special schemes for investment which are unit linked insurance plans, ULIP, National Pension Scheme, NPS, investment in employee provident fund and general provident fund. GPF is available for government servants and EPF is also available for government servant up to a certain level or in private sector. National Pension Scheme or NPS is a government scheme for retirement planning. The corpus grows through systematic market linked investments over one's working life, and when a person retires, then a fixed amount accrues to him or her from this scheme. Tax benefits and the option for a unique permanent retirement account number, or also called as PRAN, is available to the employees for life. The Pension Fund Regulatory and Development Authority, it regulates and administers the NPS. Tax benefits under section 80C and 80CC(d) are available if one decides to contribute to the national pension system. Employer contribution to the NPS account is also eligible for tax benefits. The unit linked insurance plans combine the life insurance and market linked investments. They offer protection as well as wealth creation. A portion of the premium pays for the life insurance coverage, while the rest is invested in investment funds. These funds may be either equity or debt or flexi funds, which means a combination of equity as well as debt, generally 75% equity and 25% debt. Value of the investment grows as per the performance of these chosen funds. There are fund managers who are financial experts who take decisions about investing them into the declared funds or declared whether it is equity or debt. In ULIP, there is always a lock-in period, after which the policy can be redeemed. Now, these lock-in periods generally are anything between 5 or 6 years, sometimes more. A person investing in ULIP has to take note as to what is the period to which he or she will have to be compulsorily paying the premium for the ULIP and when the returns will accrue. They have to match the long term financial goals of the family concerned. These ULIP policies also have long term capital gain benefits. Next is Employee Provident Fund. It is a government scheme that provides financial security for employees by accumulating a corpus for their retirement through employer-employee contributions. Here both the employer and employee contribute 12% of the employee's basic salary and dearness allowance. So, the employee has the benefit of having a matching contribution from the employer and it adds to his income. EPF is administered by Employees Provident Fund Organization, also called as EPFO. Its portal gives access to the employees where they can check the balance, and it also has facility to draw money in advance if there are some important events like marriages or things like that. General Provident Fund, it is a retirement scheme for government employees where they contribute a portion of their salary and earn interest. The interest rates are decided and declared by the Government of India from time to time. The capital keeps on growing and is available to the employee once he reaches the age of superannuation or leaves the service due to personal reasons, or if he takes VRS, voluntary retirement. The employee has the facility of deciding to contribute more if required. There is certain minimum level, normally 10 to 12%, which is to be paid necessarily by the employee. That person can also withdraw this money for certain functions, where instead of taking loan from the market, he can draw loan from GPF at easy rates. There is a facility to take withdrawal in case of children's marriage, children's education. There are certain rules for that. In essence, GPF is a secure, risk-free investment option, and the funds are typically dispersed upon retirement, as I told you earlier. Just a word about the financial laws in India. The first is Reserve Bank of India Act 1934, Part 2 of 1934, which provides the statutory basis of the functioning of the bank. RBI commenced its operation on 1st April 1935, and thereafter under this act RBI has attained an important position where it directs the other banks, it creates the policy for banking, it is the advisor to Government of India, and it plays a very important role within the provision of this act. Then there is a Finance Act of India, which is the fiscal legislation enacted by Indian Parliament to give effect to the financial proposal of the central government. Under this act, the Government of India declares the central budget or passes off the budget every year. This central budget is the instrument by which the country grows, funds are allocated to various sectors, funds are allocated to various states for their development. Some states get priority All these activities are done under the Finance Act of India. Then there is a Security and Exchange Board of India Act, which created this body, a statutory regulatory body for the Indian securities market, for the sole objective of protecting the investors' interest and promoting the development of stock markets. It is important to mention that Indian stock market today is one of the important premium stock markets which draw a lot of investment from foreign institutional investors. The investment scenario in India has changed thanks to the policies of SEBI. A large number of investors have opened the demat accounts and they are now actively trading and investing in equities, bonds, etc. And SEBI is the organization which ensures that it is done properly, safely, and that all fraudulent organizations, they are picked up and action is taken against them. There are some common mistakes people do, especially the salaried ones. They do not check their pay slips regularly, do not take note of deductions. They must, because it is their hard earned money, and many times due to clerical error or due to inadvertent or inadvertent errors, this deduction may not be accurate, or deduction done, but they may not reflect in the account for which they were deducted. So, that tallying is very important. Similarly, one has to look into the bank statements and see whether the money deposited by them is tallying, refunds if any have they been received in their banks. So, this basic check with the bank is necessary. Income tax return, even though it is mandatory for all assessees, many times people keep delaying the income tax return and ultimately land up paying fines and penalties for that. Not paying insurance premium is another problem, that they do not make provision for making annual premiums. So, if that is the situation, people should opt for monthly premiums, which are easy to remember and they can be deducted online from their banks. Sometimes people ignore the funds needed for emergencies, they have to have a provision for that. Then investing without understanding or research. Many times people invest in stock market based on tips which are received either by petty callers or by friends or by family members. One should avoid that. If you choose to invest, investment should begin with an amount which should be smaller to begin with. As your experience and confidence grows, keep investing more. Start small and then grow big. So, let us summarize. Salaried people must know the full details and various components of their salaries and allowances and deductions. There are number of investment options available for them. They should choose the products and the financial institutions carefully based on what are their financial goals. Besides spending judiciously, savings and investments are important. 70-20-10 strategy, as we discussed, can be a useful method of deploying funds, and then financial literacy definitely helps. Thanks for your attention.